Hello, everybody, and welcome to another episode of our Southern California Housing Market Update. My name is Stephen Mead. I am the broker of record here for Domicile Real Estate for people who love houses. And this week, what we are talking about is, are the laws of supply and demand broken? Excuse me, that cough was not intentional. Are the laws of supply and demand broken? When it comes to real estate, we're going to look at the numbers this week and we're going to talk about that because that is something that I've heard a couple prominent economists say when they're talking about the housing market. How do we get into this situation? We're in a pandemic and prices skyrocket, right? There are a lot of things that I think sort of maybe defy conventional wisdom. And we're going to get into that. We're going to talk about, kind of my feelings on that and sort of where we're going to go from here and what some of this stuff means. So let's get right into it. I don't want to waste any time on this. We kind of have a decent amount to talk about today, information that I think you will find useful. So let's go ahead here and we're going to get our slides up real quick. Okay. All righty. So the first thing that I want to talk about is where are our active listings, because I think this is something we've all been kind of waiting for these numbers to rise back up. And if we look here, we kind of have a tale of two different markets. And one of the reasons why I love breaking down and segmenting the market into under $1 million and $1 to $2 million is because very frequently these are different markets. So if you look here, our under $1 million market, beginning of the year, we saw, inventory really just languished, then it started going up. And, this past week, we've seen another increase in inventory. By no means are we flush with inventory, but I think we're approaching what I would consider more of a healthy level of inventory. A lot of you have heard me talk before about the difference between a rational and irrational market. And, I think we've got an example in the news, right, to talk about real quick. And I'm going to go screen share because I want to talk about this. So, when we're talking about a rational and an irrational market, here's a good example, right? A rational market is where consumers make decisions, they evaluate their options, they make decisions based on facts. Kind of like, my rent is $3,000 a month, and I think for $3,300 a month plus tax deduction, I can get into a house that'll work for my needs. That's a rational thought process, right? To decide to do that. An irrational market would be like, say, I'm sure a lot of you have seen the images on the news. No politics on this, but seeing people running after planes on the runway, leaving Afghanistan and grabbing a hold of a plane. That's the kind of, sort of irrational decision-making that is based on more of sort of fear and very emotionally driven decision-making, right? Like the fact is that's actually quite dangerous. Your likelihood of dying, staying in Afghanistan may be very high, but your likelihood of dying holding onto a plane that's taking off is actually pretty high. So that's kind of a bit of irrational decision making. And I think in this market, this spring especially, we've seen a lot of irrational decision making. And I'm glad to point out, I don't think we're in that irrational. And when we're in the rational decision making zone, we do have normal laws of supply and demand. But I'm going to jump back in here and I'm going to explain something for a second. So if we are to go to our next slide here, which is our new listings. I've heard a couple economists, and in fact, I have a feeling the economist in particular, if he is listening to this, he's going to send me an email telling me how I'm wrong, but it's okay. We can actually disagree on things. He's very smart. But what you would have expected, right, is what happens with supply and demand, right? One of the things that happens is when prices go up, so does supply, right? For example, if I've got a tree of oranges in my backyard and oranges are 50 cents a piece, I'm probably going to just eat whatever oranges my tree makes. But what if oranges were $100 each? Well, suddenly people are going to be putting those oranges on the market. People are going to plant orange trees. All this stuff's going to happen to increase orange supply. And the reason why I'm mentioning this, and here's my point, is we look at what happened to prices and look at what happened to supply. It didn't really increase a whole lot. These are new transactions that came into the market. And when we look here, despite rising prices, gosh, the market didn't really respond with a bunch of new listings. Why? It must be broken. Well, and I've talked about this before. I think if you take the viewpoint that the only thing sellers care about when deciding to put their home on the market is what price they're going to get for it. I think that's a very oversimplified view of seller decision making. I think the biggest component lately has been sellers' confidence of where do I go, right? It's the same thing with used cars. Now's a great time to sell a used car. Unfortunately, it also means unless you are getting rid of a car and you don't need to replace it, you have to go buy a car, right? And new car prices are up. So what is this resulting in? A used car shortage, as it were. And it's kind of the exact same thing in the housing market. So I am confident that the normal forces of supply and demand are working, that we are not in an irrational market. I think we were bordering on an irrational market earlier. But if you go back in this graph here of inventory, this is a gentle upslope indicating a market that is changing a little bit, but these are not drastic movements. I think this is a market actually functioning exactly the way we would like our real estate markets to function. So if you look at here, supply really has remained fairly constant. It went up a little bit in the spring and then it's just kind of hovered in the same zone. You also look here at our 14-day new escrows. We have a slight decline here, but this luxury $1 to $2 million market, that's been holding steady. And really, this has been pretty steady too. Now, as I mentioned, I actually don't think this is the shape of demand, right? If we're looking over time, I think that in reality, demand did something like this. So follow my pointer here. And in fact, can I actually draw things? I think I can draw something here. So let me see if I can actually draw on here. That would be pretty cool. So, okay. We're going to try drawing. I think this is actually what happened with demand. I think this represents real demand. Now, I know what you're saying, right? Is that, wait a minute, but this is the graph of new escrows. How could this be wrong? Well, I think we were basically supply limited. So I think we would have sold more houses had there been more available. And right now we're getting right back to this point where now that inventory is growing, it means that we're not supply limited anymore. And now that this is going to track like we expect. And maybe that might mean this number drops off a little bit, especially if interest rates rise, but I don't see it plummeting, right? Like this is a fairly gentle curve. These are not drastic movements on this chart. Okay, so let me clear out the drawings here. All righty. So this brings us back to our absorption rate. Oh, I gotta get back to my pointer. Okay, there we go. So this gets back to our, this is our 14-day, sorry, new listings. There we go. There's our absorption rate. So when we're looking at absorption rate, you see that our numbers did soften a little bit. If you look at the trend line on this graph, right? Like, I mean, it really shows us kind of peaking probably right around here in this March, April timeframe. And then we've actually had been cooling a little bit. I think what we drew on there was an accurate representation of demand. But I want you to understand how gradual this curve is. So I'm going to go off screen share and I'm going to say something. A lot of people think that what you want in a market is a market that is just skyrocketing all the time. Not only is that not possible, I'm not really sure that that's what you want either. Market variations happen. This is a fact of any market, especially real estate markets. Market variations happen. What you want is you want markets that follow smooth, low amplitude variations. So instead of a market that is jumping up and down like this, what you want is a market that is slowly kind of like a nice day on the ocean with your boat gently rocking. That's really probably, if you're a consumer, that's what you would like it to happen. And by all indications, I think that is the type of market that we are experiencing at the moment. I don't know if I can speak too much about too far into the future. I try not to do that. But if you look here, what we've got is a gentle easing of these absorption rates. They did bump up a little bit here because interest rates dropped back under 3. We're going to talk about our interest rate reactivity in a second. But every indication we have is that this is a fairly gentle market. Again, we've got prices rising big time in the spring here, and then kind of taking a much more level, gentle growth approach. I think a term that you'll hear me use a lot of times is inflationary price growth. That basically means that if interest rates remain constant, all things being equal, home prices should be increasing by the same rate of wage increase. All things being equal. Of course, all things are never equal, but that's kind of a general guideline. I think that's what we can sort of expect in terms of short-term price appreciation. is that it'll occur at sort of wage inflationary levels. So think that that means annualized something kind of in that 3 to 5% neighborhood. Now, this is our still active after 14 days. We look at everything that came on the market, how much of it's still around. Higher numbers are a less competitive market. What do we see? We see kind of a bottoming out here and then a gentle rise back. I think the reason why we do these longitudinal studies here, which means over time, is because we're looking for these trends to understand the shape of a market. Because we have a fairly gentle moving market this way, we have week to week variations, but the reality is, this is a market that actually is behaving in a lot of ways a lot more textbook than I think anybody's giving it credit for right now. Now, this is our list to close. I think you'll remember me talking that we were expecting to see again, if you look at this under 1 million, you see it going up, cresting, and then beginning to fall a little bit. This is sort of measuring that disconnect between buyers and sellers. Buyers think the houses are worth a lot more and they're willing to pay a lot more than sellers think their houses are worth. And that is starting to ease a little bit. Remember, this is based on closed data. So this is 4 to 6 weeks old of data. So if we extrapolate, I think the reality is going today, we're probably somewhere in this 102% neighborhood. Now, this luxury market has been a little bit more stubborn in terms of sticking at these higher levels. I'm going to be real curious to see should that $1 to $2 million upper price range, should that continue? This notion of just the new normal is that you just pay over list price for houses. I think I've mentioned this a couple times before. That is the normal in the Bay Area market, where there's just a percentage over that people somewhat expect to pay. And sellers intentionally put their houses under market. Now, here's our days on market. And this one I think is also interesting, right? We kind of see these numbers dropping through the spring and then kind of leveling out down here around 18 days for under 1 million. And then I'm going to say this as a slight upward trend, right? Just enough to show that it's getting a little bit weaker. But I mean, honestly, 20 days, folks, weaker and weak are very different arguments to make in a market. I think we've got a little bit maybe of an increase here. It's a little hard to tell because this $1 to $2 million price range, we have a lot more sort of fluctuation because our sample size is smaller. But if you look down here at under 1 million, yeah, it looks like we kind of troughed out here, and then that number is slowly starting to go up a little bit. But if you're a seller in this market, do not fret, do not despair. 20 days is still a really short period of time. And I mean, look where we were back towards the end of this year. Our numbers were quite a bit higher. I want to talk about affordability again, because, when we're talking about this dichotomy, right, the rational market versus the irrational market, the one that follows supply and demand versus the one that kind of behaves in its own erratic manner. This is further evidence to me that we are in a rational market where consumers are making rational decisions. And again, this is aggregate, right? So I mean, does that mean that every single consumer is making rational decisions? No. But across the whole, the market is acting rationally. And what I mean by that is, you notice prices basically accelerated to get us in this 110 to 120% threshold. And again, just as a reminder, everybody, using June of 2018 payments as a baseline, we are 10 to 20% higher than that. That is right where wages are. I don't think this is irrational consumer behavior. We're kind of stuck in this range. I would expect that to continue. This is a market that's reacting normally. What would bother me is if this number just kept shooting up, right? That indicates that people are being irrational. The 2006, 2007 market looks like just shooting through any sense of wage growth. But that's not what's happening in the market. We've been for several months riding in this pocket where the market is sort of adjusted to this comfort zone of equilibrium. Finally, I want to talk about mortgage rates because we have a market that is very reactive to mortgage rates. New escrow slipped a little bit, and look what happened. Mortgage rates went up a little bit. Are we still under 3? Of course we are. Are we still as low as we've been since back in February? Yes. Still great news for anybody that's out there if you're a buyer. But just remember, this is going to cause some of those week-to-week variations that we talked about. So I want to give everybody a shout out, and I've got a couple of announcements too for things. So we are starting back up to do our webinars for first-time home buyers. We talk a little bit of economics, a little bit of strategy, and a little bit about concrete options that are out there for people. We're going to have an announcement on those soon. It'll probably be in our next video. We might add it to this description too when we have kind of some of those dates and things set up. Secondly, I want to tell you that we're launching some additional content that we do not stream to Facebook Live. So if you're watching this on Facebook, definitely check out our YouTube channel. The link is in the description for this video because we have a lot of content that doesn't show up. Finally, we also have our entry-level or first-time home buyer market update that comes out on Fridays. So definitely tune in for that. Don't forget to like, subscribe, hit that notification bell. And as always, we love comments. And finally, before we leave, if you are in Southern California, Los Angeles, Orange counties, which is where we run our stats, we would absolutely love to work with you if you're looking to be a buyer or seller. We'd like to bring our expertise to help on your transaction. If you have any questions, definitely give us a holler. And thanks so much for watching. We'll see you again real soon.